This is Alan Bush with ADMIS. In the stock index futures, we are seeing lower prices this morning. However, before the pressure in the stock index futures, we did see some new contract highs in the overnight trade in the Dow futures. Pressure this morning linked to comments from European Central Bank President Mario Draghi when his statement following the European Central Bank's policy meeting was a bit less dovish than some analysts had predicted. So that immediately put pressure on stock index futures. Our feeling, though, is that futures will recover. I think there's a very good chance we can see futures trading higher on the day. The main trend still appears to be higher as well. So for the rest of this year, I would look for higher prices, and higher prices also likely well into next year for stock indices. Over in the currencies, the European currency quickly rallied on Draghi's comments. Even though there is likely to be more accommodation from the European Central Bank next year, probably in the first quarter, it now appears to be timed more toward the end of the first quarter rather than early in the first quarter. So that helped the European currencies in general, especially the euro currency. I think if the euro currency can rally another couple of days, I think that could represent a good selling opportunity for the euro. Also, we did see some new lows in the Japanese yen. The feeling there is that in the first quarter of next year, the Bank of Japan will add more liquidity to their banking system. So lower prices are likely for the yen. Also, we had pressure in the Australian dollar, with the Reserve Bank of Australia likely to ease credit conditions sometime early next year as well. Over in the interest rate markets, we are seeing futures trading mixed to a little bit better. We did have the Fed's Beige Book statement yesterday that was, for the most part, upbeat on the economy. We continue to believe that longer term, the main trend is higher for Treasury, especially at the long end. And the one thing I believe that will keep the Fed from raising interest rates in the middle of next year or late next year, which is the consensus view, is that real wages continue to stagnate. In fact, we had unit labor costs yesterday coming in with some negative numbers. So the labor situation remains very tenuous, to say the least, and that remains a very bullish situation for Treasuries, once again, especially for the long end. And this is a trend that will probably continue through this year and well into next year. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.